Crude oil has officially gone parabolic. It looks like a $120 or even $115 oil is no longer just a pipe dream. There's a very high probability we see it hit those levels this year. Last night's price action in the oil market was absolutely epic. Brent crude futures reaped 6% and spiking to a massive $120 a barrel, marking the most violent single-day rally since the outbreak of the US-Iran war. This massive pump last night was driven by two major macro catalysts. The first one is, after the second round of negotiations failed, Trump is preparing to severely escalate military pressure on Iran and reportedly planning targeted missile strikes. And second, the latest EIA weekly report confirmed a massive unexpected drawdown in US crude inventories. You have a severe supply shock colliding with a massive geopolitical risk premium, both firing at the exact same time. And that's just aggressively squeezing oil prices higher. Okay, now let's pivot to gold. While oil is throwing a massive party, gold is getting absolutely slaughtered. Acting as the inverse seesaw to oil, gold nearly peaked below $4,500 last night. The bulls were completely rooted and liquidated. A short-term bear market is now locked in. The catalyst for last night's gold dump, the complete destruction of Fed rate cut expectations. As expected, the Fed held rates steady last night. The meeting didn't release a new summary of economic projections, SAP, or a dot plot. But looking at the latest pricing from the CME FedWatch tool, the market is now pricing in a massive 66% probability of zero rate cuts for the entirety of 2026. A month ago, this figure was 72%. Wall Street's consensus at the start of the year for at least one cut in 2026 has officially gone to zero. So when that dovish hopium completely evaporates, oil goes parabolic. The DXY dollar index rips higher, and gold suffers a brutal liquidation event like we saw last night. Even with a slight dead cat bounce today, the bearish trend remains overwhelmingly clear. And finally, let's talk about US equities. The Nasdaq barely ticked up and still printed a new all-time high. Its resilience is literally suffocating the shorts. The memory and storage sector continues its massive breakout. Centix completely recovered its deep and printed new highs. Intel keeps ripping to new all-time highs, and the CPU shortage narrative has become the dominant speculative theme in the market. So what's the playbook from here? First, zero rate cuts being fully priced in will be the macro backdrop for all asset pricing over the next 6 months. And second, oil up, rate steady, dollar strong, gold down. This macro transmission chain is the main game for asset pricing moving forward. As long as oil holds above $120, gold will remain heavily suppressed, and other risk assets will face severe valuation and multiple compression. But there is one massive exception. The semiconductor and solar sectors are trading in their own isolated bull market because they are riding a massive wave of hard order backlogs. They can completely ignore oil prices and keep ripping higher. So I will remain hyper-focused on core AI plays with hard fundamental order support, along with high divided yield sectors. As always, this is just my personal trade analysis, not financial advice. And shout out to EBC Financial Group for sponsoring this content.